any management that doesn't regard depreciation as expense is, is living in a dream world. But of course, they're encouraged to do that, by investment bankers who talk to them about EBITDA, and then certain people have built fortunes on misleading investors by convincing them that EBITDA was a big deal. And Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks.
Hey, it's Tom here, and welcome back to the channel. Now, you would have seen in those first couple of clips from Warren Buffett and then Charlie Munger that those guys have a very strong distaste for terms like EBITDA, or earnings before interest, tax, depreciation, and amortization. And it really is a term that has been taken, in my view at least, too far. It's probably emerged for fairly rational reasons, like all things that tend to get taken too far. But it's still kind of everywhere in investment research. Anytime you read most kind of company investor presentations, you'll see adjusted EBITDA plastered everywhere. Typically in companies that are far better managed, in my view, you'll tend to see less of figures like EBITDA and adjusted EBITDA. But it emerged for a fairly rational reason, and it still, I think, has some uses in investment analysis. But there are certainly situations, and probably the majority of situations, where it's really a waste of time kind of using these terms. And in this video, I want to share basically the origin story of EBITDA. As nerdy as that sounds, it actually originated from John Malone, the cable cowboy. You may know him as one of the largest, I think actually the largest landowner in the USA, and the man kind of behind all of the Liberty Media complex of public companies. So it emerged for a pretty rational reason, but it's certainly been overused, and there's some traps that investors can easily fall into if they tend to pay too much attention to numbers like EBITDA. So in this video, let's cover EBITDA, what it actually is, where it came from, where it's useful, where it's not useful, and hopefully you leave this video with a good idea of when to pay attention to numbers like EBITDA and when to basically just discard them and pay closer attention to more meaningful numbers like free cash flow. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing as a Kiwi based here in New Zealand. And in 2022, Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your first home, travel the world, or become financially independent. Reaching your goal starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 30th of June 2022. Okay, so let's start this video off by talking about John Malone and the origin of EBITDA. That's probably the nerdiest thing I've ever said, but if you want to learn a lot more about John Malone and kind of his business ventures and how he became so successful, definitely check out this book, The Outsiders by William Thorndike. I'm up to the last chapter, which is actually on Warren Buffett, and I will likely finish this one today, but it's a very good book on all things capital allocation, and one of the chapters is actually dedicated to John Malone. Now, in terms of John Malone becoming sort of the cable cowboy and really building his fortune, there's basically two things that you really need to know about his business and why he came up with this term EBITDA as what he felt was a more meaningful way to understand the ability for his businesses to generate cash flow. And basically that was he was heavily invested in cable businesses, so the physical assets that came along with that, but also the intangible assets in terms of cable content. And secondly, John Malone absolutely loved to use debt as a way to basically leverage his equity, generate higher returns on equity, grow faster, and for that reason he had very substantial interest expenses in the businesses that he ran as a way to try and reduce his tax bill and grow faster. So when you looked at those cable businesses that John Malone was running at the time through the kind of old school traditional lens of good old-fashioned earnings and net income, John Malone's businesses actually reported some really, I guess, depressed numbers. But when you compared those reported earnings with the ability for John Malone's businesses to actually produce cash, and keep in mind here that the cash flow statement, one of the 3 financial statements that every company has to produce, that wasn't actually mandatory for a company to put out until 1992. So that's a very important thing to keep in mind here, where we're talking about John Malone running a lot of these cable businesses in the 80s. We didn't actually have a cash flow statement for a lot of businesses at that time. So there was a big discrepancy between the company's reported earnings and their ability to generate cash, and that was for 2 reasons. It's because he ran a cable business, which allowed him, from a tax perspective, to depreciate the physical assets at a much faster rate than their useful life actually was. So think about that like a real estate building, a rental property, where maybe it has a usable life of 80 years, but you can depreciate that asset over 40 years. So you can have this big kind of depreciation expense from a tax perspective, kind of reduce your taxable income. Similar kind of approach in the cable business for John Malone from the physical cable assets. And he also had a very similar situation with intangible assets like content. We see a similar situation at Netflix today, where they are able to amortize their content, which is basically just the equivalent of depreciation but for intangible assets. They're able to amortize their content. John Malone was able to amortize his content, and potentially, and this is part art, part science, but potentially he was able to amortize that content at a faster rate than its usable life actually was. So for these businesses, you have a lot of depreciation, you have a lot of amortization, and you actually are also paying a lot of interest because John Malone tended to carry a lot of debt. And all 3 of those things combined really depressed the net income and the generally accepted accounting principles earnings for the business, yet the company was just producing cash flow hand over fist. So that was how EBITDA basically came about. But you have to keep in mind that John Malone had a couple of very specific circumstances in his business that meant EBITDA did make sense. It truly was a better kind of description of the ability for his businesses to generate cash flow, but it certainly has been taken too far. You can't just extrapolate the use of EBITDA into any type of business. Imagine the classic depreciating asset, which is a car. If you were to try and analyze, let's say, a business that owned a fleet of taxis, and they tried to report EBITDA to you. They said, this is the true number that reflects the real cash generated from our business. It's a far better descriptor than net income. We don't think depreciation is important. Well, if the average taxi in their fleet is having to get replaced every, I don't know, let's just say 6 or 8 or 10 years or something, that is a huge cash cost and a real economic expense that you're completely ignoring. And like Warren Buffett has described it, it really is the worst type of expense. You're outlaying money up front when you buy into one of these depreciating assets, and it kind of slowly disappears over time. It's the exact reverse of what Warren Buffett has through float in his insurance companies, where he gets to hold on to people's money. He actually makes money through his insurance businesses, and he also has this mountain of cash that isn't really his, but he gets to invest it and reap the investment kind of gains on that float. So sure, EBITDA has some uses, but it has to really be in very specific situations. It cannot be rolled out in a blanket way across any type of business. You have to really understand whether those are true economic costs that you're excluding when you talk about EBITDA and you don't, include depreciation and amortization. Now, I want to spend a couple of minutes here talking about EBIT, or earnings before interest and tax. Obviously, that does include depreciation and it does include amortization, but we're just excluding interest and tax with the EBIT metric. And EBIT is something that I actually do use from time to time, and it's something that investors like Li Lu have said in business school talks at Columbia that he tends to use as well. And the reason I would use something like EBIT is not necessarily to value the business, but it's really to understand the business quality. What Li Lu says that he wants to understand is how good a business is at generating a high return on equity without the use of debt. So what kind of unlevered returns can a business generate? If it has $1 million of capital invested in the business and it's able to generate $100,000 a year in EBIT, that's kind of a 10% return on capital in Li Lu's mind. mind. And he wants to understand what that is on an unlevered basis. If you take that same business and that $1 million of capital is heavily funded by debt, that can really skew the net income if you have debt and then you don't have debt on the same business. And Lilu really uses EBIT to try and understand what the returns are on an unlevered basis. Again, if you put this in a real estate context, it might be looking at $1 million property. When you're assessing that real estate as kind of a potential rental property, you're trying to understand the rent that's going to come in, you're trying to understand what expenses you might have. You're really not paying a lot of attention to debt in the first instance. You generally try and analyze those things on an unlevered basis and then kind of pay attention to the financing later on. So EBIT is a nice way to be able to kind of standardize across different businesses that have various capital structures and various different amounts of leverage. Now, the final thing that I want to say on this whole EBIT and EBITDA discussion is that anytime that I am using one of these metrics, it's really about understanding business quality, and it's about understanding the company's ability to generate cash in the operations of their business. So if it is using, EBIT at the Lilu way, analyzing things like they were a rental property, I'm just trying to understand the quality of the business. How much capital does it require, and what type of earnings kind of come in the door. With the John Malone example, which is more extreme and quite specific to that industry, I would say, again, it's about trying to understand the cash generating ability of the business. What I am not using EBIT and EBITDA for, typically at least, is for valuation. All that really matters at the end of the day in terms of valuing a business is how much cash are you putting into it and how much cash flow is coming back to you as an owner. So yes, I might use EBIT to understand whether I think it's a high quality business or not, but when it comes to valuation, that's when I'm shifting to metrics like free cash flow, or if it's a more complicated situation where they're reinvesting a lot of their cash flow for growth, I might use Warren Buffett's sort of owner earnings approach, where rather than taking the free cash flow, which is operating cash flow minus capital expenditure, so business produces $1 million in operating cash flow, spends $200,000 on capital expenditures, so he has $800,000 in free cash flow. Rather than taking that approach, if they're investing a lot of cash flow for growth, I would attempt to split out the capital expenditures between growth and maintenance. So if that same business produces $1 million in cash flow from operations and they go ahead and invest $500,000 for growth and $200,000 for maintenance, it's really only the $200,000 for maintenance that I would take off. So even though they would have quite low free cash flow because there's a lot of investment for growth happening, they would have more substantial sort of owner earnings. So if we're just paying attention to the cash they could generate if they were only focusing on maintaining their business. So that is probably one of the nerdier accounting focused videos that I've made on the channel, but I do hope you enjoyed it. If you did, please hit like and also subscribe to the channel if you are new here. If you're interested in the hatch offer, that will be the first link down in the description below as well. But that's it from me for this one, and I'll see you in the next video. Cheers.